Some investors might be thinking that the AI investing trend is overdone, that maybe the bubble is bound to pop very soon. While there might be a few AI stocks that are overvalued, there are also plenty of AI stocks that are undervalued. In fact, I'm going to highlight 3 AI stocks that are undervalued right now in this video. Importantly, the way I determine if something is overvalued or undervalued is comprehensive. I look at the whole picture. The mistake I see many investors make is looking at the market price only. That's where you start to feel nervous about investing because you may have noticed the market price is up 144%. And so you might think, wow, that's too much too quickly. However, that fails to account for what you are getting in return for the price you are paying. Isn't that a critical part of the equation? Are you not always willing to pay more if you're getting more in return? Between institutions and enterprises, spending on artificial intelligence is soaring. Real dollars and profits are soaring industry-wide. So of course the market prices are likely to be higher. Anyways, this introduction is already longer than usual, so let's look at these 3 undervalued AI stocks. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. The first undervalued AI stock I'm going to bring to your attention is Qualcomm. This stock is trading at a forward price to earnings of 14.33. Qualcomm is going to benefit from the rising effectiveness of AI and the shift in computing to the edge. Qualcomm will benefit as devices such as personal computers and smartphones are embedded with increasing amount of semiconductors to facilitate the growing computational power that's required for artificial intelligence on the edge. Qualcomm is in a great position to benefit from that trend. Over the last decade, you'll notice Qualcomm's revenue has increased nicely, $37.35 billion in the most recent trailing 12-month period. That's up from around $26 billion 10 years ago. And like its revenue, its operating income has also increased to $8.7 billion. Now, if you take the operating income and you divide it by revenue, you'll notice Qualcomm has an above 20% operating profit margin, which is solid, especially if you consider that the company is just coming off a cyclical downturn. You'll notice that downturn there, and it's recovering from that trend and is in a position to benefit to new highs as the industry is poised to expand given the rising spending in artificial intelligence. And Qualcomm is just now entering into the personal computing industry with its new Snapdragon products, and that's poised to add to the company's market share in that segment, which will bring up its revenues and profitabilities. Now, the other thing I like to look at when I'm measuring investments is the return ratios. So I've highlighted 3 return ratios here: return on invested capital, return on equity, and return on assets. This measures a company's profits while using investor money. So what does it do with the money that it gets from investors, and how good is it at turning it into profits? And if you look at the most important ratio of this metric is the return on invested capital. For Qualcomm, it's 22.83%, and the other metrics are also doing very well with 38% on return on equity. Now, the reason I say return on invested capital is the most important one because oftentimes companies have, let's say, $10 billion in cash in their bank account, and that's counted as assets. And if you measure their return on assets, companies that have a lot of cash are penalized because those cash assets are not earning as high as their operational assets are. So if you just measure return on invested capital, you'll get the money that the company earns on money that the company puts into use, puts into business use. So that out of these 3 ratios, I value the return on invested capital the highest, but I look at the others as well just to kind of get a gauge on how good the company is at using leverage, managing the financial balance sheet, etc. The next undervalued AI stock I'm going to bring to your attention is NVIDIA. And you might be surprised to hear me say that NVIDIA is an undervalued AI stock because it's already up over 100% year to date in 2024. But this is precisely an example of a scenario which I highlighted at the beginning of the video, where the stock has a higher market price, but what you're getting in return is so much more that it's still undervalued because you're getting so much more in return over this year compared to what you were getting with NVIDIA last year or just 2 years ago. NVIDIA is trading at a forward price to earnings of 26.4, which is right about where it was trading at around April of 2024. And in these last 5 or 6 months, the company has made tremendous progress. And in fact, in the last 2 years, the company has made tremendous progress. Look at how revenue and operating income has exploded since 2022. In 2022, NVIDIA generated $30 billion in revenue. In the most recent trailing 12 months, it's $96 billion. So revenue has more than tripled in 2 years. More than tripled in 2 years. And those are not empty calories. NVIDIA's operating income has increased by even more than what revenue has increased. Operating income in 2022 was roughly $10 billion, and it's now $60 billion. So you're getting a company with 3 times more in revenue and 6 times more in profit than you were getting a year and a half ago. So wouldn't you be willing to pay a higher price for a company that has more than tripled its revenue and more than 6 times its profit? I know I would, right? Paying a double price for a company with triple the revenue and 6 times the operating income is still a bargain. So that's why I say it's important to look at what you're getting in return and not just focus on the market price, because you'll miss out on situations where you're still getting a great value. You're just having to pay a higher price, but you're getting more in return. And the thing you're getting more in return is business fundamentals like revenue, profit, cash flow, etc. And if you look at NVIDIA's returns metrics, return on invested capital, 102.6% in return on invested capital from NVIDIA. This is a remarkable business achievement, one that I don't think is sustainable, I'll be frank, but it doesn't need to be. Even if NVIDIA continues its return on invested capital of, the averages of the last, between 2018 and 2022 of like 40%, 45%, it would still make a really good investment. But I think it's going to be even above that. I think it's going to be somewhere in between 102 and 40%. But a achievement of this magnitude just demonstrates how successful NVIDIA has been in its industry, in its research and development, in creating products that the market absolutely must have. And last but not least, Micron Technology. You're getting this stock at a forward price to earnings of just 6.889, the cheapest you've been able to get this stock in the last year. Micron Technology sells memory and storage for devices, and this category, just like Qualcomm, Micron will benefit from similar trends. Now, investors are spooked about Micron Technology because this company is spending billions of dollars in manufacturing expansion. Investors are always concerned when companies invest significantly in manufacturing expansion. However, I think those fears are overdone for 2 reasons, one of which I'll share with you with the company's return metrics. But the other reason is because Micron is investing into a market tailwind that is supported by government incentives, billions of dollars in government incentives. So the timing is right. And you look at Micron Technology's revenue over a trailing 12-month period, $21 billion. And just like Qualcomm that has a cyclical ups and downs, Micron is even more so. It's a cyclical business. The semiconductor industry is cyclical. And you can see that in Micron, where you have big ups and downs every couple of years. and it's just now coming off of that cyclical bottom. Now, if you're considering investing in cyclical businesses, it's good to look where you're at in the cycle. If you're at the very tippy top of the cycle, you have to be careful in investing in these cyclical businesses. But Micron is just coming off of the bottom of the cycle, right? You can see that here. It had the recent cyclical bottom, and it's now recovering from that. And the tailwinds behind it are proven across industries. The personal computer industry is entering into its biggest replacement cycle in history, enhanced by the AI products being infused, and each personal computer is going to need more memory and more storage so that it can utilize artificial intelligence. And similar with its return on invested capital ratios and other return ratios, you can see it coming off the cyclical bottom here, coming right back on the bounce back. But if you look at the average across the last decade, you can see that during the peaks, this company can generate close to 50% return on invested capital, return on equity. And so when you look at the bottoms here, you got to have the foresight to notice the company does go through these cycles, and it's just now coming off of that cycle, and it's now entering into a booming replacement cycle in its end markets. And management has said as much, that they are expecting a really strong year in 2025 and 2026, and they're investing in capacity expansions in future years as well. So there you have it, 3 undervalued AI stocks you can buy today. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.